Welcome back, everybody, to another Tips for Mortgage video series. This one is definitely on the weekly rate update because of Bank of Canada increased quarter point today, only a quarter point, which is crazy. Anyway, my name is Mike Parkinson. I'm a mortgage broker with Dominion Lending Centers in Campbell River, British Columbia. My cousin Jaden Bax, who's with Avenue Financial. He's all the way from Mexico today.
Yeah,
Holidays. He's doing this on holidays.
Yeah, we want to talk to you guys all the time. This is important day, important announcement. We get to hear from our good buddy Tiff Macklin again. Yeah, we're very happy to be talking to you guys today. Yeah, it was a as expected a small hike, Mike, but Tiff kind of left the door open, but at the same time said this should be it, right?
It's politics, Jay. He's just going to give an average answer because they can't tell you that they want people to lose their jobs. They can't tell you that they want, that they screwed up, that they kept rates too low for too long. So it's politics, right? So I can see this being the last. Personally, that's just my opinion. Unless they come out with some numbers in the next month or so that are better than average, which is slightly possible because everything's lagging so much, but I think they're starting to get caught up. But pretty much, I think this is it. I think they're going to pause now and see, and I don't know how long their pause is going to last before they do start cutting rates. And again, it's anybody's guess, but my opinion is that, and the markets are actually pricing in some rate cuts after the 6-month period this year or something like that. Some economists think they're going to stay high. These rates are going to stay around for longer, which I can't see. But again, who knows, right? It depends what the Bank of Canada does, the Feds do, what their policies come out with. So I just think I think this is it. And I think by this time next year, we should see some lower rates. We're already seeing the long-term bond yields drop. Short-term yields are still high, the inverted curve. Obviously, which means recession is either here or coming, right? So it's just how hard is the recession going to be? How deep is it going to be, and how long? So,
yeah, and we see, like I've been saying this to all my clients. I think this, and everybody's kind of talking about it. We're not going to feel that recession in Alberta the same way. You guys are definitely going to feel it in BC, Ontario, Quebec.
Yep.
But Alberta, I think is going to skate through this recession, just kind of on the back of oil and gas being hiked up with what's happening in Russia and Ukraine, and then also the tech influx that we've had over the last couple of years into southern Alberta, especially into Calgary. A couple of things that seem to be propping up the economy. And honestly, like you say, like they're talking about, maybe rates might be up for the rest of the year. There's also a lot of indication because they're thinking that, the big goal in all of this is we got to push inflation down to 2%. That's their benchmark. 3% is acceptable, but 2% is kind of the ideal, right? And so everything that Tiff Macklin does in the Bank of Canada and everybody around him is to push that number down to 2%. And so they're already talking about themselves. The Bank of Canada is saying, we think that it will be down to 3% by the end of the year. Several big economists think they're way off the mark. That mid-year we'll be looking at 3% inflation, and that we'll be maybe pushing past that and into a recession by mid-year in a way that the government is going to have to take action again to undo what they've done, just as they're taking action to undo what they've done before. So hopefully they can get this seesaw ride through, find a little bit of stability. And as that's all happening in the background, we're seeing a world marketplace that's starting to stabilize as well, right? And so these kind of vaunted, like everybody's always talking about supply chain problems. Nobody ever thought about supply chain problems for the last 15, 20 years. But all of these supply chain problems are starting to get themselves slowly back in track. And so we're hopeful that, all of that filters through the entire economy, right? And so as that kind of happens, pricing stabilizes, rates can come back down. We'll have a hopefully more normal mortgage marketplace for the second half of 2023.
Yeah, we pray for that. So it's been such a seesaw, right? Just like scary to a gong show now to scary again compared, like it's just been up, down, up, down. but I agree with the supply chain issue, and I follow David Rosenberg a lot, and he thinks that it's all supply chain now as things open. They're tightening rates, they're increasing rates, and taking money out of the system when the economy's slowing and the supply chain's opening, and all the retail sales numbers coming out are pretty weak. So everything's pointing towards weakness in the economy. So it'll be interesting. They always go overboard one way or the other. They go too far up, too far down. They haven't been right, I don't know, ever or very often. So I don't know. They talk about things, so who knows?
And the big companies are making the same mistakes, right? Like you look at these layoffs at Google and Amazon, and
Yep.
all of these big tech companies. And it's not just the tech guys going; it's guys across the spectrum. All of this money started rolling in as pricing went up, as the governments around the world were pouring money into the economies, and these guys hired like crazy, right? And so one of the big indicators of heading into recession tends to be mass layoffs, and we're seeing it in certain sectors. And I think this, like Mike says, so supply chain will catch up. We're going to see some of these mass layoffs happening. Continue to happen in different sectors across the country, and we're heading into the recession that they say is going to be a soft landing, but I don't know how you can fall on your butt and not hurt a little bit, right?
Yeah, and honestly, we don't have a crystal ball. This is just kind of what our opinions are based on what we've been following, and throwing a little bit of reality in there as well. Is when you increase this much in 1 year interest rates, 4 years of rates in 1 year kind of increases, something's going to break, something's going to happen. And it's the world economy that's having issues, everything in the world, not just one area, right? So,
yeah.
So it's, we'll wait and see, but that's kind of our prediction. Is we can see things, the economy weakening, getting into a recession, and then hopefully this time next year we'll see lower rates. And right now, with the increase, bank prime rate is at 6.7.
Yeah.
As of today, so you're going to start to see the banks are going to start sending out updates, which we're starting to get, saying bank prime is now 6.7. So whatever, if you're in a variable rate, true variable rate mortgage, an adjustable rate mortgage, then your payment's going to adjust there. If you're in a true variable rate mortgage and you're in static payments, something to look into to make sure you don't hit that trigger point rate that we talked about in the past. So make sure you check with your broker or lender. If you have any questions, please give us a call. And if anytime, if you know anybody that's interested or has questions or concerns, we're here to help. So I hope you enjoyed this. Do you have anything else to say, Jay?
Yeah, I would say absolutely. And the other thing is, if you're thinking about buying this spring, buying in the summer or the fall, definitely give us a call, because I think we like to go past the easiest thing in the world to sell is a 5-year fix, your grandfather's 5-year fix, right? And we want to be talking about all of these options. Variable is a terrible product right now. It doesn't mean that it's going to average out as the worst product over the next 5 years when you compare it to the 5-year fix. So let's have a real conversation about where things are going, what's happened in the past, what we can expect going forward, and how to minimize your payments over that 5-year term.
Exactly. And that's one thing I love these videos, because we don't edit them or anything. So, we get all over the place. We miss points we want to talk about. So it's nice to have two people here so that we can bounce off each other. That's a great point, Jay. So right now, fixed rates, as I mentioned, the long-term bond yields have been coming down. So fixed rates, like the longer-term fixed rates, 3-year, 4-year, 5-year, and up are coming down, but the shorter-term rates are staying high right now. Doesn't mean that you should take a 5-year fixed and, at say 4.74 or whatever it is today, just because it's lower than the shorter terms. It's something that we need to talk to you about as far as strategy goes. What that means is if interest rates did drop over the next year or two, like down to 2%, then you're paying, 4 3/4, which is a lot more. It seems great today, but it might not be in the future. So just strategies that we can discuss with you, and then in the end, you make the decision, right, based on what we've come up with. So, yeah. So, anything else, Dad?
No, yeah, it was great. Great seeing you guys from sunny Mexico. We'll tune in again next week, and we'll hopefully, we know at least next week it won't be any Bank of Canada updates, right? We can just give a regular update. Don't have to talk about any of those guys at all.
We'll have some positive news for you. So anyway, hang in there and give us a shout anytime. We hope you enjoyed the video, and we'll see you next week.
Okay, bye, guys.
Take care, Jay.